If you ask me to distill trading down to its simplest form, I would say that it is a pattern recognition of margin. We use market analysis to identify the pattern, define the risks, and determine when to take profit. The trade either works or it doesn't. In any case, we go on the next trade is as simple but certainly not easy. In fact, trading is probably the hardest thing you will ever attempt to be successful at. That's not because it requires intellect but the contrary, but because the more you think you know, the less successful you will be. Trading is hard because you have to operate in a state of not having to know, even though your analysis may turn out at times to be perfectly correct. To operate in a state of not having to know, you have to properly manage your expectation. To properly manage your expectation, you must realign your mental environment so that you believe without a shadow of doubt in the five fundamental truths. In this chapter, I am going to give you a trading exercise that will integrate these truths about the market at a function level in a market environment. In the process, I will take you through the three stages of development of a trader. The first stage is the mechanical stage. In this stage, you know build the self-trust necessary to compete in an unlimited environment, learn to flawlessly execute a trading system, train your mind to think in probabilities, create a strong, unshakable belief in your consistency as a trader. Once you have completed this first stage, you can then advance to the subjective stage of trading. In this stage, if you use anything you have ever learned about the nature of market movement to do whatever it is you want to do. There's a lot of freedom in this stage, so you will have to learn how to monitor your susceptibility to make the kind of trading results that are the result of any unresolved valuation issue I referred to in the last chapter. The third stage is intuitive stage. Trading intuitively is the most advanced stage of development. It is the trading equivalent of owning a black belt in the martial arts. The difference is that you can try to be intuitive because intuition is spontaneous. It doesn't come from what we know at a rational level. The rational part of our mind seems to be inherently mistrustful of information received from a source that it doesn't understand. Sensing that something is about to happen is a form of knowing that is very different from anything we know rationally. I have worked with many traders who frequently had a very strong intuitive sense of what was going to happen next, only to be confronted with the rational part of themselves that constantly argued for another course of action. Of course, if they had followed their intuition, they would have experienced a very satisfying outcome. Instead, what they ended up with was usually very unsatisfactory, especially when compared with what they otherwise perceived as possible. The only way I know of that you can try to be intuitive is to work at setting up a state of mind most conducive to receiving and acting on your intuitive impulse. The mechanical stage. The mechanical stage of trading is specifically designed to build the kind of trading skill, cross comprehension thinking in probabilities that will virtually compel you to trade consistent result. I define constant result as a steadily rising equity curve with only minor drawdowns that are the natural consequence of a that didn't work. Other than finding a pattern that puts the odds of winning trading in your favor, achieving a steadily rising equity curve is a function of systematically eliminating any susceptibility you may have to making the kind of fair, historical, self-relation based trading errors I have described towards the group. Eliminating the error and expanding the sense of self-valuation will require the acquisition of skills that are psychological in nature. The skills are psychological because each one in its purest form is simply a belief. Remember that the belief we operate out of will determine our state of mind and shape our experience in a way that constantly reinforce that we already believe to be true. How true a belief is can be determined by how well it serves us. This is the degree to which it helps us satisfy our objective. If producing consistent result is the primary objective as a trader, then creating a belief that I am a constantly successful trader will act as primary source of energy that will manage the perception, interpretation, expectation and action in a way that satisfies the belief and consequently the objective. Creating a dominant belief that I am a constantly successful trader requires adherence to several principles of constant success. Some of these principles will undoubtedly be in direct conflict with some of the belief you have already acquired about trading. If this is the case, then what we have is classic example of beliefs that are in direct conflict with desire. The energy dynamic here is no different from what it was for the boy who wanted to be like the other children who were not afraid to play with dogs. He desired to express himself in a way that he found at least initially virtually impossible to satisfy his desire. He had to step into an active process of transformation. His technique was simple. He tried as hard as he could to stay focused on what he was trying to accomplish, and little by little he deactivated the conflicting belief and strengthened the belief that was constant with desire. At some point, if this is your desire, then you will have to step into the process of transforming yourself into a constant winner. When it comes to personal transformation, the most important ingredient are a willingness to change, the clarity of our intent and the strength of our desire. Ultimately, for this process to work, you must choose constantly over every other reason or justification you have for trading. If all of these ingredients are sufficiently present, then regardless of the internal obstacle you find yourself up against, what your desire will eventually prevail. Observe yourself. The first step in the process of creating consistency is to start noticing what you are thinking, saying, and doing. Why? Because everything to because everything we think, see, or do as a creator contributes to and therefore reinforces some belief in our mental system. Because the process of becoming consistent is psychological in nature, it should not come as a surprise that you will have to start paying attention to your various psychological process. The idea is eventually to learn to become an objective observer of your own thoughts, words, and deeds. Your first line of defense against committing trading error is to catch yourself thinking about it. Of course, the last line of defense is to catch yourself in the act. If you don't commit yourself to becoming an observer to this process, your realization will always come after the experience, usually when you are instead of deep regret and frustration. Observing yourself objectively implies doing it without judgment or any harsh criticism as a consequence of what you are noticing about yourself. This might not be so easy for some of you to do, considering the harsh judgmental treatment you may have received from other people throughout your life. As a result, one who belongs to a state and mistake of emotional pain. No one likes to be in a state of emotional pain, so we typically avoid acknowledging what we have learned to define as a mistake for as long as possible. Not confronting mistake in our everyday life usually doesn't have the same disastrous consequences it can have if we avoid confronting our mistake as traders. For example, when I'm working with floor traders, the analogy I use to illustrate how precarious a situation they are in is to ask them to imagine themselves walking across a bridge over the Grand Canyon. The width of the bridge is directly related to the number of contracts they trade. So, for example, for a one contract trader, the bridge is very wide, say 20 feet. A bridge 20 feet wide allows you a great deal of tolerance for error, so you don't have to be inordinately careful or focused on each step you take. Still, if you do happen to stumble and trip over the edge, the drop to the canyon floor is 1 mile. I don't know how many people will walk across a narrow bridge with no guardrails or the ground is a mile down, but my guess is relatively few. Similarly, few people will make the kind of tricks associated with trading on the floor of the future exchange. Certainly, a one contact floor trader can do a great deal of damage to himself, not unlike falling off a mile high bridge. But a one contact trader can also can give himself a wide tolerance for errors, miscalculation, or unusually violent market moves that where he could find himself on the wrong side. On the other hand, one of the biggest floor traders I have worked with trades for his own account with the average position of 500 treasury bond future at a time. He often puts a position of well over 1,000 contracts. A position of 1,000 T-bond contracts amount to 31,500 per tick. Of course, T1 future can be very volatile and can trade several ticks in either direction in a matter of seconds. As the size of trader position increases, the width of our bridge over the Grand Canyon narrows. In the case of the large bond trader, the bridge has narrowed to the size of thin wire. Obviously, he has to be extremely well balanced and very focused on each step that he takes. The slightest misstep or burst of wind could cause him to fall off the wire next step 1 mile down. Now, when he is in trading pit, that tiny misstep or slight gust of wind is the equivalent to one distracting thought. That's all just a thought or anything else where he allows himself to lose his focus for even a second or two. In that moment of distraction, he could miss his last favorable opportunity to liquidate his position. The next price level with enough volume to take him out of his trade could be several ticks away, either creating a huge loss or forcing him to give a substantial winning trade back to the market. If producing constant result is a function of eliminating errors, then it is an understatement to say that you will encounter great difficulty in achieving your objective if you can acknowledge the mistake. Obviously, this is something very few people can do, and it accounts for why there are so few constant winners. In fact, the tendency not to acknowledge a mistake is so pervasive throughout material, it could lead one to assume that it's an inherent characteristic of human nature. I do believe that if this is the case, or nor do I believe we are born with the capacity to ridicule or think less of ourselves for making a mistake, miscalculation, or error. Making mistake is a function of living and will continue to be until we reach a point at which all our beliefs are in absolute harmony with our desire, and all our beliefs are structured in such a way that they are completely consistent with what works from the environment perspective. Obviously, if our beliefs are not consistent with what works from environment perspective, the potential for making a mistake is high, if not inevitable. We want to be able to perceive the appropriate set of steps to our objective. Worse, we want to be able to perceive that what we want may not be available or available in the quantity we desire or at the time when we want it. On the other hand, mistakes that are the result of beliefs that are in conflict with our objective aren't always apparent or obvious. We know that they will act as opposing force, especially in the burden of the truth on our consciousness, and they can do that in say many ways. The most difficult to detect is a distracting thought that causes a momentary lapse in focus or concentration. On the surface, this may not sound significant, but as in the analogy of bridge over the canyon, when there's a lot at stake, even a slightly diminished capacity to stay focused can result in an error of disastrous proportion. This principle applies whether it's trading, sporting event, or computer programming. When our intent is clear and undiminished by any opposing energy, then our capacity to stay focused is greater, and the more likely it is that we will accomplish our objective. Earlier, I defined a winning attitude as a positive expectation of our effort with an acceptance that whatever result we do are the perfect reflection of our level of development and what we need to learn to do better. What separates the constant great actions and performance from everyone is the distinct lack of fear of making a mistake. The reason why they aren't afraid is that they don't have a reason to think less of themselves when they do make a mistake, meaning they don't have a reservoir of negatively charged energy waiting to well up and pounce on their conscious thought process like a lion waiting for the right moment to pounce on its intended prey. What accounts for this uncommon capacity to quickly move beyond their errors without criticizing themselves? One explanation may be that they grew up with extremely unusual parents, teachers, and coaches who, by their words and example, taught them to correct their miscalculation and errors with genuine love, affection, and acceptance. I say extremely unusual because many of us grew with just the opposite experience. We were taught to correct our mistake or miscalculation with anger, impatience, and a distinct lack of acceptance. It is possible that for a great athlete, their past positive experience with respect to mistake caused them to acquire a belief that mistake simply point the way to where they need to focus their effort to grow and improve themselves. With a belief like that, there is no source of negatively charged energy and consequently no source of self-denigrating thoughts. However, the rest of us who did grow up experience a plethora of negative reaction to our action will naturally acquire belief about mistake. Mistake must be avoided at all costs. There must be something wrong with me if I make a mistake. I must be a screw up or I must be a bad person if I make a mistake. Remember that every thought, word, and deed reinforces some belief we have about ourselves. If by repeated negative self-criticism we acquire a belief that we are screw up, and that belief will find a way to express itself in our thoughts, causing us to become distracted and screw up, in other words, causing us to say things about ourselves or about others that reflect our belief and our action, causing us to behave in ways that are overtly self-sabotaging. If you are going to become a constant winner, mistake can exist in the kind of negatively charged context in which they are held by most people. You have to be able to monitor yourself to some degree, and that will be difficult to do if you have the potential to experience emotional pain. If and when you find yourself in the process of making an error, if this potential exists, you have two choices. You can work on acquiring a new set of positively charged belief about what it means to make a mistake, or along with deactivating any negatively charged belief that will argue otherwise, cause you think less of yourself for making a mistake. If you find this first choice undesirable, you can compensate for the potential to make errors by the way you set up by your trading regimen. This means that if you are going to trade and not monitor yourself, but at the same time you desire constant result, then trading exclusively from the mechanical stage will resolve the dilemma. Otherwise, learning how to monitor yourself is a relatively simple process once you have read yourself how negatively charged energy associated with mistake. In fact, it's easy. All you have to do is decide why you want to monitor yourself, which means you first need to have clear purpose in mind. When you are clear about your purpose, simply start directing your attention to what you think you are doing. If and when you notice that you are not focused on your objective or on the incremental step to accomplish your objective, choose to redirect your thoughts, word, or action in any way that is consistent with what you are trying to accomplish. Keep redirecting as often as necessary. The more willfully you engage in this process, especially if you can do it with some degree of conviction, the faster you will create a mental framework for you to function in a way that is consistent with your objective without any restriction from a conflicting belief. The role of self-discipline. कति हो रहा यार ये चावल ऐसे रिपीटेडली करा. The role of self-discipline. I call the process as I describe self-discipline. I define self-discipline as a mental technique to redirect our focus of attention to the object of our goal or desire when that goal or desire conflicts with some other component of our mental environment. The first thing you should notice about the definition is that self-discipline is a technique to create a new mental framework. It is not a personality trait. People are not born with self-discipline. In fact, when you consider how I define it, being born with discipline isn't even possible. However, as a technique to be used in the process of personal transformation, anybody can choose to use self-discipline. Here is an example from my life that illustrates the underlying dynamics of how this technique works. In 1978, I decided that I wanted to become a runner. I don't exactly remember what my underlying motivation was, except that I had spent the previous 8 years in a very inactive lifestyle. I wasn't involved with any sport or hobbies, unless you call watching television a hobby. Previously, in both high school and at least part of college, I was very active in sports, especially ice hockey. However, coming out of college, my life was unfolding in a way that was very different from what I had expected. It was not to my liking, but at the time I felt powerless to do anything about it. This led to a period of inactivity, which is a nice way of saying that I was severely depressed. Again, I'm not sure what prompted me to suddenly want to become a runner. Maybe I saw some TV program that sparked my interest. I do, however, remember that motivation was very strong. So I went out and bought myself some running shoes, put them on, and went out to run. The first thing I discovered was that I could not do it. I didn't have the physical stamina to run more than 50 or 60 yards. This was very surprising. I did not realize, nor would I have ever believed, that I was so out of shape that I could not run even 100 yards. This realization was so disheartening that I did not attempt to run again for 2 or 3 weeks. The next time out, I still couldn't run more than 50 or 60 yards. I tried again the next day with, of course, the same result. I became so discouraged about my deteriorated deteriorated physical condition that I did not run for another 4 months. Now it's the spring of 1979 and I'm once again determined to become a runner, but at the same time very frustrated with my lack of progress. As I was contemplating my dilemma, it occurred to me that one of my problems was that I didn't have a goal to work towards. Saying that I wanted to be a runner was great, but what did that mean? I really didn't know, but it was too vague and abstract. I had to have something more tangible to work towards, so I decided that I wanted to be able to run 5 miles by the end of summer. 5 miles seemed insurmountable at the time, but thinking that I might be able to do it generated a lot of enthusiasm. This increased level of enthusiasm gave me enough impetus to run 4 times that week. At the end of the first week, I was really surprised to discover even a little bit of exercise improved my stamina and ability to run a little farther each time. This created even more enthusiasm, so I went out and bought a stopwatch and blank book to be used as running diary. I set up 2 mile goals and marked off each quarter mile in the diary. I entered the date, my distance, my time, and how I felt physically each time I ran. Now I thought I was well on my way to the 5 miles until I literally ran out into my next set of problems. The biggest were on the conflicting and distracting thoughts that flooded my consciousness every time I decided I wanted to go out and run. I was amazed at the number of the reason I found for not doing it. It looks like it's going to rain. I am still a little tired from the last time I ran. Nobody else I know is doing this or the most prevalent. I will go as soon as the TV program is over. I didn't know any other way to deal with this conflicting mental energy as to redirect my conscious attention toward what I was trying to accomplish. I really wanted to get to 5 miles by the end of the summer. I found that sometimes my desire was stronger than the conflict. As a result, I managed to get my running shoes on and actually step outside and start running. However, more times than not, my conflicting and distracting thoughts caused me to stay put. In fact, in the beginning stage, I estimated that 2 thirds of the time I was unable to get past the conflicting energy. The next problem I encountered was that when I started acknowledging the point where I was able to run 1 mile, I was so thrilled with myself that it occurred to me I was going to need an additional mechanism to get me to the 5 miles. I reasoned that once I got to the point where I could run 2 or maybe 3 miles, I will be so overwhelmed, pleased with myself that I will not feel a need to fulfill any 5 mile objective. So I made a rule for myself. You could call it the 5 mile rule. If I manage to get my running shoes on and get outside in spite of all the conflicting thoughts trying to talk me out of it, I committed myself to running at least one step farther than the last time I ran. It was certainly alright if I ran more than one step further, but I could not be less than one step, no matter what. As it turns out, I never broke this rule, and by the end of summer, I made it to 5 miles. But then something really interesting and completely unanticipated happened before I got there. As I got closer to fulfilling my 5 mile objective, little by little, the conflicting thoughts began to dissipate. Eventually, they didn't exist at all. At that point, I found that if I wanted to run, I was completely free to do without any mental resistance, conflict, or conflicting thoughts. Given that what I struggle it has been, I was amazed. The result, I went on to run on a very regular basis for the next 16 years. For those of you who may be interested, I don't run so much now because 5 years ago I decided to start playing ice hockey again. Hockey is an extremely strenuous sport. Sometimes I play as many as 4 times a week. Considering my age over 50 and the level of exhaustion the sport requires, it usually takes me a day or two to recover, which doesn't have much room for running anymore. Now, if we take this experience and put them into the context of what we now understand about the nature of lived area or number of observations we can make, Initially, my desire to be a runner had no foundation or support in my mental system. In other words, there are no other source of energy. I actually had to do something to create the support. To create a belief that I am a runner required that I create a series of experience constant within the new belief. Remember that everything we think here do contributes energy to some belief in our mental system. Each time I experienced a conflicting thoughts and I was able to successfully refocus on my objective with enough conviction to get me into running shoes and out the door. I added energy to the belief that I am a runner, and just as important, I inadvertently drew energy away from the belief that will argue otherwise. I say inadvertently because there are various techniques especially designed to identify and deactivate conflicting belief, but at that time in my life I did not understand the underlying dynamics of the process of transformation I was going through, so I will not have occurred to me to avail myself of such technique. Now I can effortlessly from a mental perspective express myself as runner because I am a runner. That energized concept is now a functional part of my identity. When I first started out, I happened to have a number of conflicting beliefs about running. As a result, I needed the technique of self-discipline to become one. Now I don't need self-discipline because being a runner is who I am. When our beliefs are completely aligned with our goals or desires, there's no source of conflicting energy. If there's no source of conflicting energy, then there's no source of distracting thoughts, excuses, rationalization, justification, or mistake. Belief can be changed, but if it's impossible to change one belief, then it's possible to change any belief. If you understand that you really aren't changing them, but are only transferring energy from one concept to another. Therefore, two completely contradictory beliefs can exist in your mental system side by side. But if you have drawn the energy out of one belief and completely energized the other, no contradiction exists from a functional perspective. Only the belief combined with the energy will have the capacity to act as a force on your state of mind, on your perception and interpretation of information, and your behavior. Now the sole purpose of trading mechanical is to transform yourself into constantly successful trader. If there is anything elementary involvement that is in conflict with the principle of creating the belief that I am a constantly successful trader, then you will need to employ the technique of self-discipline to integrate this principle as a dominant functioning part of your identity. Once the principle become who you are, you will no longer need a self-discipline because the process of being constant will become effortless. Remember that consistency is not same as ability to put on a winning trade or even a string of winning trade for that matter, because putting on a winning trade requires absolutely no skill. All you have to do is guess correctly, which is no different than guessing the outcome of a coin toss. Whereas consistency is a state of mind that once achieved won't allow you to be any other way. You won't have to try to be consistent because it will be a natural function of your identity. In fact, if you have to try, it is an indication that you haven't completely integrated the principle of constant success dominant on conflicted belief. For example, predefining your risks is the step in the process of being consistent. If it takes any special effort to predefine your risks, if you have to consciously remind yourself to do it, if you experience any conflicting thoughts, or if you find yourself in a trade where you haven't predefined your risks, then this principle is not dominant functional part of your identity. It isn't who you are. If it were, it will not even occur to you not to predefine your risks. If and when all the source of conflict have been deactivated, there is no longer a potential for you to be any other way. What was once a struggle will become a virtuously effortless at the point it may seem to other people that you are so disciplined. But the reality is that you aren't being disciplined at all. You are simply functioning from a different set of belief and compel you to behave in a way that is consistent with a desired goal or objective. Creating a belief in consistency. Creating a belief that I am a constant winner is the primary objective, but like my intention to become a runner is to broad and abstract implement without breaking it down into step-by-step process. So what I'm going to do is break this belief down into its smallest definable parts and then give you a plan to integrate each part as dominant belief. The following sub-beliefs are the building blocks that provide the underlying structure for what it means to be a constant winner. I am a constant winner because I objectively identify my age. I predefine the risks of every trade. I completely accept the risks or I am willing to let go of the trade. I act on my age without reservation or registration. I pay myself as the market makes money available to me. I continually monitor my susceptibility for making errors. I understand the absolute necessity of this principle of constant function and therefore I never violate them. These beliefs are the 7 principles of consistency. To integrate this principle into your mental system at a functional level requires that you purposely create a series of experiences that are consistent with them. This is no different from the boy who wanted to play with the dogs or my desire to be a runner. Before he could play with a dog, the boy first had to make several attempts just to get close to one. Eventually, as the balance of energy in his mental system shifted, he could play with dogs without any internal resistance. To become a runner, I had to create the experience of running in spite of everything inside me that argued otherwise. Eventually, as the energy shifted more and more in favor of this new definition of myself, running became a natural expression of my identity. Obviously, what we are trying to accomplish here is far more complex than becoming a runner or petting a dog, but the underlying dynamics of the process are identical. We start with a specific objective. The first principle of consistency is the belief. I objectively identify my edges. The key word here is objectively. Being objective means there is no potential to define, interpret, and therefore perceive any market information from either a painful or euphoric perspective. The way to be objective is to operate out of belief that keep your expectation neutral and to always take the unknown force into consideration. Remember, you have to specifically train your mind to be objective and to stay focused in the now moment opportunity flow. Our mind are not naturally wired to think this way, so to be an objective observer, you have to learn to think from the market perspective. From the market perspective, there are always unknown forces waiting to act on price movement. Therefore, from the market perspective, every movement is truly unique, even though the movement you may look, sound, or feel exactly the same as some movement log away in your memory bank. The instant you either decide or assume you know what's going to happen next, you will automatically expect to be right. However, what you know, at least at the rational level of thinking, can only take into consideration your unique path, which may not have any relationship to what is actually happening from the market perspective. At that point, any market information that is not consistent with your expectation has the potential to be defined and interpreted as painful. To avoid experience the pain, your mind will automatically compensate with both conscious and subconscious pain avoidance mechanism for any difference between what you expect and what the market is offering. What you will experience is commonly referred to as illusion. In a state of illusion, you are neither objective nor connected to the now movement opportunity flow. Instead, you become susceptible to committing all the typical trading errors. The 5 fundamental truths about the market will keep your expectation neutral. Focus your mind in the now moment opportunity flow, and therefore eliminate your potential to commit these errors. When you stop making trading errors, you will begin trusting yourself. As your sense of self-trust increases, so will your sense of self-confidence. The greater the confidence, the easier it will be to execute your trades. The fifth truth will also create a state of mind in which you will genuinely accept the risks of trading. When you genuinely accept the risks, you will be at peace with any outcome. When you are at peace with any outcome, you will experience a carefree, objective state of mind, where you make yourself able to perceive and act upon whatever the market is offering you at any given now moment. The first objective is to integrate as a dominant belief. I objectively identify my edge. The challenge now is how do you get there? How do you transform yourself into a person who can constantly think in the market perspective? The process of transformation starts with a desire and a willingness to refocus on the object of your desire. Desire is a force. It doesn't have to coincide or agree with anything that you currently believe or to be true about the nature of trading. A clear desire aims squarely at the specific objective is a very powerful tool. You can use the force of your desire to create an entirely new version or dimension to your identity, shift energy between two or more conflicting concepts, or change the context or polarity of your memories from negative to positive. I am sure you are familiar with the saying, make up your mind. The implication of making up your mind is that we decide exactly what we desire with so much clarity and with so much conviction that literally nothing standing in our way, either internally or externally. If there is enough force behind our result, it's possible to experience a major shift in our mental structure virtually instantaneously. Deactivating internal conflict is not a function of time, it's a function of focused desire. Otherwise, in the absence of extremely clarity and conviction, the technique of self-discipline over time will do the job quite nicely. To get there, you must make up your mind with as much conviction and clarity as possible that more than anything else you desire consistency from your trading. This is necessary because if you are like most traders, you are going to be up against some formidable conflicting force. For example, if you have been trading to get high from the euphoria of catching a big move, to impress your family and friends, to be a hero, or to fulfill an addiction to random reward, to be right about prediction, or for any other reason that has nothing to do with being consistent, then you will find the force of this other motivation will not act only as obstacle, making the trading exercise I am about to give you very difficult, but it will very well be strong enough to keep you from doing the exercise at all. Remember the boy who had no desire to be like the other children and interact with dogs. In essence, he decided to live with the active contradiction between his minimally charged positive belief that not all dogs are dangerous and his core negatively charged belief that all dogs are dangerous. He had the ability to perceive friendly dogs, but at the same time found it impossible to interact with them unless he desired to change it. The imbalance of energy between these two beliefs will stay exactly as it is for his entire life. To even start this process, you have to want consistency so much that you will be willing to give up all the other reason, motivation, or agendas you have for trading that are consistent with the process of integrating the belief that create consistency. A clear intense desire is an absolute requisite if you are going to make this process work for you. Learning to trade an edge like a casino. The object of this exercise is to convince yourself that trading is just a simple game of probabilities, not much different than pulling the handle of slot machine. At the micro level, the outcome to induce is an independent occurrence and random in relationship to one another. At the macro level, the outcome over a series of trades will produce constant result. From a probabilities perspective, this means that instead of being the person playing the slot machine as a trader, you can be the casino if you have an edge that generally puts the odds of your success in your favor. You can think about trading in the appropriate manner. You can do everything you need to do over a series of trades. Then, like the casino, you will own the game and a constant winner. Constant winner. Setting up the exercise. Choose one actively traded stock or future contract to trade. It doesn't matter what it is as long as it's liquid and you can afford the margin requirement for trading at least 300 shares or 3 future contract per trade. Choose the set a market behavior that define NS. This can be a trading system you want. The trading system or methodology you choose can be mathematical, mechanical or visual. It doesn't matter whether you personally design the system or purchase it from someone else. Nor do you need to take a long time or be too picky trying to find or develop the best or right system. This exercise is not about system development and it is not a test of your analytical abilities. In fact, the variable you choose can even be considered mediocre by most traders standard because what are you going to learn from doing this exercise is not dependent upon whether you actually make money. If you consider this exercise on educational expense, it will cut down on the amount of time and effort you might otherwise expend trying to find the most profitable areas. For those of you who might be wondering, I am not going to make any specific recommendation about what system or variable you should use because I assume that most of the people reading this book are already well skilled in technical analysis. If you need additional assistance, there are hundreds of books available on the topic, as well as a system mentor who are more than willing to sell you their ideas. However, whatever system you do choose to use has to fit within the following specification. Trade entry. The variable you use to define your age have to be absolutely precise. The system has to be designed so that it does not require you to make any subjective decision or judgment about whether your age is present. If the market is aligned in a way that conforms with the rigid variable of a system, then you have or trade. If not, then you don't have a trade period. No other extraneous or random factor can enter into equation. Stop loss exists. The same condition applied to getting out of trade that's not working. Your methodology has to tell you exactly how much you need to risk and to find out if the trade is going to work. There is always an optimum point at which the possibility of a trade not working is so diminished, especially in a relationship to the profit potential, that you are better off taking your loss and getting your mind clear to act on the next stage. Let the market structure determine where this optimum point is rather than using an arbitrary dollar amount that you are willing to risk on a trade. In any case, whatever system you choose, it has to be absolutely exact, requiring no subjective decision making. Again, no extraneous or random variable can enter into equation. Time frame. Your trading methodology can be in any time frame that suits you, but all your entry and execution have to be based on the same time frame. For example, if you use variable that identify a particular support and resistance pattern on a 30-minute bar chart, then your risk and profit objective calculation also have to be determined in a 30-minute time frame. However, trading in one time frame does not preclude you from using other time frame as filter. For example, you could have as a filter a rule that states you are only going to take trades that are in the direction of the major trend. There is an old trading axiom that the trend is the friend. It means that you have a higher probability of success when you trade in the direction of the major trend, if there is one. In fact, the lowest risk trade with the highest probability of success occurs when you are buying dips in an up-trending market or selling rallies in a down-trending market. To illustrate how this rule works, let's say that you have chosen a precise way of identifying support and resistance pattern in a 30-minute time frame as a range. The rule is that you are only going to take trades in the direction of the major trend. A trending market is defined as a series of higher highs and the higher lows, or up-trending market and a series of lower highs and lower lows, or a down-trending market. The longer the time frame, the more significant the trend. So a trending market on a daily bar chart is more significant than a trending market on a 30-minute bar chart. Therefore, the trend on the daily bar chart will take precedence over the trend on the 40-minute bar chart and will be considered the major trend. To determine the direction of the major trend, look at what is happening on a daily bar chart. If the trend is up on the daily, you are only going to look for a sell for retracement down to what is defined as support on the 30-minute chart. That's where you will become a buyer. behave. To determine the direction of the major trend, look at what is happening on the daily bar chart. If the trend is up on the daily, you are only going to look for a sell of or retracement down to what is defined as support on the 30-minute chart. That's where you will become a buyer. On the other hand, if the trend is down on the daily, you are only going to look for a rally of what is defined as the resistance level to be a seller on the 30-minute chart. Your objective is to determine in a downtrending market how far it can rally on an intraday basis and still not violate the symmetry of the longer trend. In an uptrending market, your objective is to determine how far it can sell off on an intraday basis without violating the symmetry of the longer trend. There is the ability with this intraday support and a resistance point, because you don't have to tell the market go very far beyond them to tell the trade is not working. Taking profit, believe it or not, of all this one need to learn to be constantly successful trader. Anything to take profit is probably the most difficult to master. A multitude of persons often very complicated psychological factors as well as the effectiveness of one market analysis enter into the equation. Unfortunately, sorting out this complex matrix of issue goes way beyond the scope of this book. I poured this out so that those of you who might be inclined to beat yourself up for leaving money on the table can relax and give yourself a break. Even after you acquire all the other skills, it might take a very long time before you get this one down pat. Don't despair. There is a way to set up a profit-taking regime that at least fulfills the objective of the fifth principle of consistency. If you are only going to establish a belief in yourself that you are a constant winner, then you will have to create experience that correspond with that belief, because the object of the belief is winning constantly. How you take profit in a winning trade is of paramount importance. This is the only part of the exercise in which you will have some degree of discretion about what you do. The underlying premise is that in a winning trade you never know how far the market is going to go in a direction. Market really go straight up or straight down. Typically market go up and then retrace some portion of upward move, or go down and then retrace some portion of the downward move. This proportional retracement can make it very difficult to stay in a winning trade. You would have to be an extremely sophisticated and objective analyst to make the distinction between the normal retracement. When the market still has the potential to move in the original direction of a trade, and a retracement that is the normal one, the potential for any further development in the original direction of a trade is greatly diminished, if not non-existent. If you never know how far the market is going to go in the direction, then when and how do you take profit? The question of when is the function of ability to read and market and pick the most likely spot for it to stop. In the absence of an ability to do this objectively, the best course of action from a psychological perspective is to divide the position into third and scale out the positive as the market moves in your favor. If you are trading future contracts, this means your minimum position for trade is at least 3 contracts. For each of the minimum position is any number of shares that is divisible by 3. So you don't end with an odd lot order. That's the way I scale out of a winning position. When I first started trading, especially during the first 3 years, I would thoroughly and regularly analyze the result of my trading activities. One of the things I discovered was that I rarely got stopped out of trade for a loss. Without the market first going at least a little way in my direction, on average, only way out of it. Every 10 trades was an immediate loser that never went in any direction. Out of the other 25 to 30% of trades that were ultimately losers, the market usually went in my direction by 3 or 4 ticks before revising and stopping me out. I calculated that if I got into the habit of taking at least a third of my original position of every time the market gives me those 3 or 4 tax, at the end of the year the accumulated winning could go along with towards paying my expense. I was right. To this day, I always, without reservation or hesitation, take a portion of winning position whenever the market gives me a little to take. How much that might be depends on the market. It will be a different amount in each case. For example, in Treasury bond future, I take a third of a position of 1. I get 4 ticks. In the S&P future, I take a third of profit of 1 and a half to 2 full points. In a bond trade, I usually don't risk more than 6 ticks to find out if the trade is going to work. Using a free contract trade as an example, here's how it works. If I get into position and the market immediately goes against me without giving me at least 4 ticks, I get stopped out of the trade for an 18 tick loss. But as I've indicated, this doesn't happen often. More likely the trade goes in my favor by some small amount before becoming a loser. If it goes in my favor by at least 4 ticks, I take these 4 ticks on one contract. What I have done is reduce my total ticks on the other 2 contracts by 10 ticks. If the market then stopped me out of the 2 last contracts, the net loss on the trade is only 8 ticks. If I don't get stopped out on the last 2 contracts and the market moves in my direction, I take the next third of the position of at the some predetermined profit as objective. This is based on some longer time frame support or resistance, or on the test of previous significance high or low. When I take profit on the second third, I also move the stop loss to my original entry point. I have a net profit on the trade regardless of what happens to the last part of the position. On other words, I now have risk-free opportunity. I can emphasize enough, nor can the publisher make the words on this page big enough to stress how important it is for you to experience the state of risk-free opportunity. When you set up a position in which there is risk-free opportunity, there is no way to lose unless something extremely unusual happens, like a limit up or limit down move through your stop. If under a normal circumstance there is no way to lose, you get to experience what it really like to be in that trade with a relaxed, carefree state of mind. To illustrate this point, imagine that you are in a winning trade. The market, you made a very significant move in your direction, but you didn't take any profit because you thought it was going even further. However, instead of going further, the market trades all the way back to very close to your original entry point. You panic, and as a result, you liquidate the trade because you don't want to let what was once a winning trade turn into a loser. But as soon as you are out, the market bounces straight back into what would have been a winning trade. If you had locked in some profit by scaling out, putting yourself in a risk-free opportunity situation, it's very unlikely that you would have panic or felt any stress or anxiety for that matter. I still have a thought of my position left. What now? I look for the most likely place for the market to stop. This is usually significant higher low in the longer time frame. I place my order to liquidate just below that spot in a long position or just above the spot in a short position. I place my order just above or just below because I don't care about squeezing the last tick out of the trade. I have found over the years that trying to do that just isn't worth it. One other factor you need to take into consideration is the risk to reward ratio. The risk to reward ratio is the dollar value of how much risk you have to take related with the profit potential. Ideally, your risk to reward ratio should be at least 3:1, which means you are only risking $1 for every $3 of profit potential. If your age and the way you scale out of a trade give you a 3:1 risk to reward ratio, your winning trade percentage can be less than 50% and you will still make money constantly. A 3:1 risk to reward ratio is ideal, however, for the purpose of this it doesn't matter what it is. Not also matters how effectively you scale out, as long as you do the best you can to pay yourself at reasonable profit level where the market makes the money available. Every portion of a trade that you take off as a winner will contribute to your belief that you are a constant winner. All the number will eventually come into better alignment as you believe in the ability to be constant become stronger. Thoughts. Trading in sample size. The typical trader practically lives or dies on the result of the most recent trade. If it was a winner, he will likely go to the next trade. If it wasn't, he will start questioning the viability of his sales. To find out what's better work, how well they work, and what doesn't work, we need a systematic approach, one that doesn't take any random variable into consideration. This means that we have to expand our definition of success and failure from the limited trade perspective of the physical trader to a sample size of 20 trades or more. Any age you decide on will be based on some limited number of market variables or relationship between those variables that measure the market potential to move either up or down. From the market perspective, each trader who has the potential to put on or attack of a trade can act as a force on price movement and is therefore a market variable. No is the technical system take into consideration every trader and its reason for putting on or taking off a trade. As a result, any set of market variables that defines an edge is like a snapshot of something very fluid, capturing only a limited portion of all the possibilities. When you apply When you apply any set of variable to the market, they may work very well over an extended period of time, but after a while you may find that their effectiveness diminishes. That's because the underlying dynamics of the interaction between all the participants is changing. New traders come into the market with their own unique ideas on what is high and what is low, and the other traders leave. Little by little, this change after the underlying dynamics of how the market moves to no snapshot can take this subtle change into consideration. You can compensate for the subtle change in the underlying economics of market movement and still maintain the constant approach by trading in sample size. The sample size has to be large enough to give your variable a fair and adequate test, but at the same the small enough to show that if your effectiveness diminishes, you can forfeit it before you lose an inordinate amount of money. I have found that a sample size of at least 20 trades fulfills both of these requirements. Testing. Once you decide on a set of variables that are conform to this specification, you need to test them to see how well they work. If you have the appropriate software to do this, you are probably already familiar with the procedure. If you don't have the testing software, you can either forward test a variable or hire a testing service to do it for you. If you need a recommendation for testing service, contact me at mark.plus.com or tradinginthe.zone.com for referral. In any case, keep in mind that the object of exercise is to use trading as a vehicle to learn how to think objectively. as if you were a casino operator. Right now, the bottom line with performance of a system isn't very important, but it is important that you have a good idea of what you can expect in the way or win to lose ratio. Accepting the risks. The requirement of this says that you know in advance exactly what the risk is on each trade in the 20 trade sample size. As you now know, knowing the risks and accepting the risks are two different things. I want you to be as comfortable as possible with the dollar value of the risks you are taking in the exercise, because the exercise requires that you use a 20 trade sample size. The potential risk is that you will lose on all 20 trades. This is obviously the worst case scenario. It is likely an occurrence as that you will win on all 20 trades, which means it isn't very likely. Nevertheless, it is a possibility. Therefore, you should set up the exercise in such a way that you accept the risks of losing on all 20 trades. For example, if you are trading S&P future, your age might require that you risk 3 points per contract to find out if the trade is going to work. Since the exercise requires that you trade a minimum of 3 contracts per trade, the total dollar value of the risk per trade is 2,250. If you use big contracts, the accumulated dollar value of risk if you lose on all 20 trades is $45,000. You may not be comfortable risking $45,000 on this exercise. If you are not comfortable, you can reduce the dollar value of the risk by trading S&P mini contracts. They are 1/5 the value of the one big contract, so the total dollar value of the risk per trade goes down to $450, and the accumulated risk for all 20 trades is $9,000. You can do the same thing if you are trading stocks. Just keep on reducing the number of shares per trade until you get to a point where you are comfortable with the total accumulated risk of all 20 trades. What I don't want you to do is change your established risk parameter to satisfy your comfort levels. If based on your research we have to determine that a 3-point risk in the S&P is the optimum distance you must take the market trade against is to tell you it isn't worth staying in the position. When leave it at 3 points, change the variable only if it is warranted from a technical analysis perspective. If you have done everything possible to reduce your position size and find that you still aren't comfortable with the accumulated dollar value of losing on all 20 trades, then I suggest you to do the exercise with the simulated brokerage service. With a simulated brokerage service, everything over the process of putting on and taking a trade, including fills and brokerage statement, is the same as with an actual brokerage firm, except that the trades are not actually entered into the market. As a result, you don't actually have any money at risk. Or simulated brokerage service is an excellent tool to practice with in real time. Under real market conditions, it is also an excellent tool for a forward testing or trading system. Doing the exercise, damn. When you have a set of variables that conforms to the specification described, you know exactly what each trade is going to cost to find out if it's going to work. You have a plan for taking profit and you know what you can expect as a win-loss ratio for a sample size. Then you are ready to begin the exercise. The rules are simple. Trade your system exactly as you have designed it. This means you have to commit yourself to trading at least the next 20 occurrence of your age, not just the next trade or next couple of trades. But all 20 no matter what, you cannot deviate, use or be influenced by any other extraneous factor or change the variable that define your age until you have completed a full sample size. By setting up the exercise with the rigid variables that define your age, relatively fixed odds and our commitment to take every trade in the sample size, you have created a trading regime that duplicates how a casino operates. Why do casino make constant money on an event that has an outcome? Because they know that over a series of events the odds are in their favor. They also know how to realize the benefit of favorable odds. They have to participate in every event. They can engage in the process of picking and choosing which hand of blackjack, spin of roulette wheel, or roll of the dice they are going to participate in by trying to predict in advance the outcome of each of this individual event. If you believe in the 5 fundamental truths and you believe that trading is just a probability game, not much different from the pulling the handle of a slot machine, then you will find that this is will be effortless. Effortless because you desire to follow through with your commitment to take every trade in your sample size and belief in the probabilistic nature of trading will be in complete harmony. As a result, there will be no fear, resistance, or distracting thoughts. What will stop you from doing exactly what you need to do when you need to do it without reservation or hesitation, nothing. On the other hand, if it hasn't already conquered to you, this exercise is going to create a hand-on collision between your desire to think objectively in probabilities that all the forces study that are in conflict with the desire. The amount of difficulty you have in doing this exercise will be in direct proportion to the degree to which this conflict exists. To one degree or another, you will experience the exact opposite of what I described in the previous paragraph. Don't be surprised if you find your first couple of attempts at doing this exercise virtually impossible. How should you handle this conflict? Monitor yourself and use the technique of self-discipline to focus on the objective. Write down the 5 fundamental truths and the 7 principles of consistency and keep them in front of you at all times when you are trading. Repeat them to yourself frequently with conviction. Every time you notice that you are thinking, saying, or doing something that is inconsistent with this truth or principle, acknowledge the conflict. Don't try to deny the existence of conflicting force. They are simply part of the psyche that are understandably arguing further version of the truth. When this happens, refocus on exactly what you are trying to accomplish. If your purpose is to think objectively, disrupt the association process. Step through your fear of being wrong, losing money, missing out, and leaving money on the table. Every time you actually do something that confronts one of the five fundamental truths, you will be drawing energy out of the conflicting belief and adding energy to a belief in probabilities and in your ability to produce constant result. Eventually, your new belief will become so powerful that it will take no conscious effort on your part to think that act in a way that is consistent with your objective. You will know for sure that thinking probability is a functioning part of your identity when you will be able to go through say one sample size of at least 20 or more traits without any difficulty, resistance, or conflicting thoughts distracting you from doing exactly what you mechanical system call for. Then and only then will you be ready to move into the more advanced subjective or intuitive stage of trading. Try not to prejudge how long it will take before you can get through at least one sample size of trade, following your plan without deviation, distracting thoughts, or hesitation to act. It will take as long as it takes. If you wanted to be professional golfer, it will not be unusual to trade ratio to hitting 10,000 or more per person until the precise combination of movement in were so ingrained in your muscle memory that you no longer had to think about it consciously. When you are out there hitting those golf you aren't playing an actual game of someone or winning the big tournament. Do it because you believe that skill acquisition and practice will help you win. Learning to be a constant winner as a trader is an indifferent. I wish you get great prosperity and will say good luck. But you really don't need luck if you work at acquiring the appropriate skills.